Tomorrow morning, the US government wakes up to another financial emergency. Banks are under pressure. Markets are falling. Confidence is disappearing by the hour. Who do they call? You might expect the biggest bank in America, or maybe the oldest investment firm on Wall Street. But that's not what happened. Not once. Twice. Instead, they turned to a company that most Americans have never bought a product from, and many have never even heard of. BlackRock. Why? How did a firm that doesn't build cars, make smartphones, or sell anything to ordinary consumers become one of the most influential institutions in global finance? If you've searched for BlackRock online, you've probably seen two completely different stories. One says it's simply the world's largest asset manager. The other claims it's a hidden empire quietly controlling corporations, markets, and even governments. Those are extraordinary claims. But before we believe either one, let's do something much more useful. Let's follow the evidence. Because the real story isn't about secret meetings or shadow governments. It's about how one idea quietly changed the architecture of modern finance. And strangely enough, that story begins with failure. Years before BlackRock existed, Larry Fink was one of Wall Street's brightest young bond traders. He had everything going for him: a fast-rising career, a reputation for being exceptionally talented, and a front-row seat to one of the fastest-growing parts of the financial industry. Then, almost overnight, everything changed. A bad interest rate bet reportedly cost his employer around $100 million. On Wall Street, mistakes that large usually become the last chapter of someone's career. For Larry Fink, it became the first chapter of something much bigger. Instead of asking how to make more money, he started asking a different question. How do you truly understand risk before it's too late? That question would eventually become the foundation of BlackRock. In 1988, Fink and 7 partners launched a new investment firm. Not with promises of spectacular returns, not with a revolutionary product, and not with a plan to become the biggest name on Wall Street. Their goal was much simpler: build a company that understood financial risk better than anyone else. At first, it didn't sound like the kind of idea that would change the world. Risk isn't exciting. No one puts risk management on the front page of a newspaper, but financial history keeps teaching the same lesson. Banks fail because they underestimate risk. Investors lose fortunes because they misunderstand risk. Entire financial systems can collapse when risk is hidden in places nobody is looking. BlackRock believed that if it could measure those risks better than everyone else, the money would eventually follow. The company didn't become famous overnight. In fact, for years, almost nobody outside the financial industry knew it existed. BlackRock wasn't selling products to consumers. Its clients were pension funds managing teachers' retirement savings, insurance companies protecting millions of families, university endowments funding future research, governments investing public money. Quietly, one institution after another began placing its trust in the company. And with every new client, BlackRock grew. Not because the company owned that money, but because people trusted it to manage it. That difference is incredibly important. Even today, one of the biggest misconceptions about BlackRock is that it owns the trillions of dollars associated with its name. It doesn't. Most of those assets belong to its clients. BlackRock manages them on their behalf and earns management fees for doing so. It sounds like a technical distinction, but it changes how you understand everything that comes next. Because if BlackRock wasn't becoming powerful by owning the world's wealth, then where was its influence actually coming from? The answer wasn't inside BlackRock. It was hidden inside a much bigger transformation that was quietly changing how millions of people invested their money. And almost nobody realized it was happening. That transformation started with a surprisingly simple question. For decades, Wall Street had convinced investors that success depended on finding the smartest fund manager, the person who could consistently pick tomorrow's winning stocks. It sounded convincing. Pay higher fees, trust the experts, beat the market. But as more researchers studied decades of investment performance, they noticed something uncomfortable. Many professional fund managers weren't consistently beating the market after fees. Some did for a while, very few did forever. That discovery changed everything. Instead of trying to outsmart the market, Why not simply own the market? Index funds and exchange-traded funds, better known as ETFs, allowed investors to buy small pieces of hundreds, sometimes thousands, of companies in a single investment. If the economy grew, their investments grew with it. The strategy was simple, low-cost, diversified, and for millions of long-term investors, it made perfect sense. BlackRock saw this shift earlier than many of its competitors. Then came the decision that would redefine the company forever. In 2009, as the world was still recovering from the worst financial crisis since the Great Depression, BlackRock announced a $13.5 billion acquisition of Barclays Global Investors. Included in that deal was iShares, already one of the world's largest ETF businesses. It wasn't just another corporate acquisition. It completely changed BlackRock's position in global finance. Almost overnight, it became the world's largest asset manager. But here's the fascinating part. Most people weren't deliberately choosing BlackRock. They were choosing low-cost investing. Every month, workers contributed to retirement accounts. Parents invested for their children's future. Employers automatically enrolled millions of employees into pension and retirement plans. Financial advisors recommended diversified portfolios instead of expensive stock-picking strategies. One by one, these decisions seemed ordinary. Together, they created something extraordinary. Money from millions of independent investors was flowing into the same investment ecosystem. Not because someone planned it, because the financial system itself was changing. And as BlackRock grew larger, something else quietly grew with it. Influence. Not the kind that comes from political office, the kind that comes from managing capital on behalf of millions of people. Think about it this way. If a pension fund owns shares in a company, those shares usually come with voting rights. Shareholders vote on board members, executive pay, corporate governance, sometimes even major strategic decisions. Now imagine managing funds that own shares in thousands of companies around the world. Apple, Microsoft, Amazon, JP Morgan Chase, ExxonMobil, Coca-Cola. The shares don't belong to BlackRock. They belong to the clients invested through those funds. But someone still has to exercise many of those voting rights. That's where the conversation begins to change. Critics argue that a handful of giant asset managers have accumulated too much influence over corporate America. Supporters see something different. They argue these firms are simply carrying out fiduciary responsibilities on behalf of millions of investors who entrusted them with their money. Both sides are discussing the same facts. They're just interpreting them differently. And that's what makes this debate so important. Because the real question isn't whether BlackRock secretly controls the world. There is no credible public evidence that it does. The real question is whether modern finance has become so concentrated that a small number of firms now play an outsized role in shaping global markets. That question became impossible to ignore in 2008. As the financial system began to break down, governments desperately searched for experts who understood the complex securities at the center of the crisis. Among the firms asked to provide advisory services was BlackRock. Supporters said the choice was obvious. Its expertise in risk management and fixed income markets made it one of the few firms capable of handling such a complicated task. Critics asked a different question. If governments repeatedly rely on the same private company during financial emergencies, where should the line between public responsibility and private influence be drawn? BlackRock has consistently maintained that it worked under strict contractual obligations and conflict management procedures. Even so, the debate never disappeared. And when the COVID-19 pandemic triggered another financial shock in 2020, history repeated itself. The Federal Reserve again hired BlackRock to assist with parts of its emergency bond buying programs. Once again, supporters called it practical. Once again, critics called it concerning. The story wasn't getting simpler. It was becoming more complicated. Because the deeper you look into BlackRock, the more you realize this isn't really a story about one company. It's a story about how modern capitalism evolved, about what happens when millions of ordinary investment decisions, repeated month after month for decades, create institutions whose influence extends across nearly every corner of the global economy. And perhaps the biggest surprise of all, BlackRock didn't become an invisible giant because it stayed hidden. It became an invisible giant because the financial world changed around it. Most people simply didn't notice until it had already happened.
As you can see, our current allocation is optimal.
Agreed. Let's proceed. What about real estate?
We'll rebalance.